Hi, everyone. I'm Mike Pacito with I Am Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for watching our April 2026 update, Headline Mayhem and Correlation Confusion on the I Am Global Partner DBI Managed Futures Strategy ETF, ticker DBMF. So by the time you hear this, DBMF will have hit its 7-year anniversary. The strategy went live as an ETF on May 7th, 2019, after converting from its previous SMA format, which launched in 2016. Since then, DBMF has become the largest managed futures strategy in the Morningstar systematic trend category, with more than $3.5 billion in assets. Thanks to all of our clients for believing in what we're looking to accomplish for allocators, advisors, and most importantly, investors. Okay, let's get to the update, Andrew. Over to you.
Thanks, Mike. So on a price basis, we're up 1.4% or so in April and are up 9.3% this year. Now, both figures are slightly behind the performance of the SGCTA index and Morningstar category. Candidly, the market volatility is so extreme right now that it's nearly impossible to draw any conclusions from small performance differences. More significantly, I think if you dial back 2 pages, you'll see that year over year, we're up a pretty astonishing 28%, 1,000 basis points ahead of the hedge funds represented by the SocGen CTA, and even more so ahead of the Morningstar peers. So overall, this has been a terrific start to the year and a remarkably good 12 months for the strategy, which doesn't mean on a day-to-day basis that it's been an easy ride. As shown in the upper right, we've had headline mayhem around the war in the Persian Gulf. Each week or weekend, we get these huge market moves around the latest escalation or de-escalation. A very practical impact, as touched on in the second bullet, is that even the major markets are acting like meme stocks. Crude oil up 90% this year alone and over the past 12 months. And over the past 12 months, gold up by a third and many equity markets up, 40 to 50%. So plus in the last bullet, the correlation structure of the market keeps shifting. So last month, both crude and equities rose, which is a bit counterintuitive given how a rise in crude was viewed as highly bearish as recently as a month or two ago. Hence, we expect to see higher than average day-to-day noise for the foreseeable future. More colloquially, I guess, strap in, peoples. So here's our performance since launch of DBF in 2019. As Mike mentioned, we are celebrating the 7th anniversary of the launch of the fund. Hooray! Since inception, we've outperformed the SGCTA index by more than 350 basis points per annum, and the Morningstar peers by precisely 450 basis points per annum. Perhaps more relevant to allocators, as we've added a few stats in the table below. First, note that the beta of DBMF to the S&P 500 has been slightly negative, and even slightly more negative than both the SGCTA and Morningstar category. And then note that alpha generation has also been much higher, around 740 basis points per annum, an extraordinarily high figure for a hedge fund, let alone an ETF version of a hedge fund. What this tells you is that outperformance of DBMF relative to the hedge funds represented by the SocGen CTA and mutual fund ETF category is structural, not due to taking on hidden risks. Further, since we have the Bloomberg AG in there for comparison, note that bonds have had a positive correlation to stocks and 370 basis points of negative alpha. Now, these stats make our case for CTAs and especially DBMF as the cornerstone of the third leg of the asset allocation stool. Here's our usual slide on volatility adjusted positioning. The green bars are the volatility adjusted exposure of our 10 futures contracts at the end of April, and the red dots are positioning at the end of March. Moving from left to right, we've maintained our crude oil exposure, which we started to add in January, and continue to cut back on the long gold position after the sharp reversal in March. We've added to a spread trade between the euro and yen. We have very little conviction in treasuries, and we've shifted from a big bet on the rotation from U.S. into non-U.S. developed markets, expressed as a long EFA and short S&P as recently as a month ago, to just a long position in emerging markets. As noted repeatedly, given the volatility in the markets, we should expect positioning to continue to adjust as CTAs hunt for direction. And finally, here's our year-to-date contribution to performance. At the end of April, the big money maker has been a long position in crude oil, not surprisingly given the 90% spike in oil this year. We still have year-to-date gains in equities, but as noted last month, the extraordinarily sharp reversal in EFA and EM after the outbreak of the war resulted in giving back most year-to-date gains. The sharp reversal in the yen on the last day of April, caused by the Bank of Japan intervening in markets, cost us about a point of performance. So overall, given the extreme volatility in markets, including the major markets we trade, we are very, very pleased with the results this year. And with that, back to you, Mike.
Okay, thanks, Andrew. So let's wrap up here with long-term performance numbers for DBMF. Annualized return since inception, including the month that was April 2026, is now 9.24%. That's ahead of the SocGen CTA index by over 350 basis points annualized. It's ahead of the Morningstar systematic trend category average by over 445 basis points, and long-term outperformance against the traditional diversifier for equities, that's bonds, as represented by the Bloomberg AG, well intact, DBMF outperforming by over 770 basis points annualized. So thanks everyone, as always, for checking out our monthly videos. If you have any suggestions in terms of things you'd like to see added, changes, feedback, or inputs, please let us know. Otherwise, if you have more questions about the strategy, would like further information, or just a call with us, please don't hesitate to reach out. Send us an email at team@imgp.com.